Good afternoon to everyone. We're now entering our fourth week of intently focusing on policies here in Washington that might mitigate in some ways the economic fallout from the COVID-19 virus. Obviously, the main thing is the health and safety of everyone, and we're hoping that the health officials can find a virus or vaccine as soon so everyone can get back to work. In the meantime, obviously, there's been a tremendous upheaval of America's economy, tremendously impacting the real estate industry. So we've been hard at work on a variety of things. We've been at the Federal Reserve working on the lending facilities, trying to make them work as good as they possibly can for us. As you know, we've successfully amended the TALF to be extended to AAA rated legacy CMBS loans. We'd like that to go further and deeper into the credit ladder, into all investment grade CMBS. We've also been focused on the payroll protection plan intently on Capitol Hill. And as you know, it's run out of money. Today, Congress will begin to recapitalize that with $310 billion, about 260 of it directly unlimited money through the PPP, and the balance that will go to rural and minority banks and so forth. On top of that, we've been focused on how we can help perhaps replace the income that tenants lose, either through a business interruption insurance or ongoing through a pandemic insurance program or something like that. So there's a lot of things going on, but there's a great deal of policy that's very important to our industry going on sort of below the surface, but it's critical. And we're going to talk about that today. And that is the tax issues, deadlines, different things, debt modifications, and so forth. So I'm delighted that Ryan McCormick, one of our senior vice presidents dealing with tax here at the Real Estate Roundtable, has joined me. So welcome, Ryan. How are you today?
Great. Thank you, Jeff.
Good. I know you've been working quite hard on this. Why don't you talk to us a little bit about what we've been asking the IRS and Treasury to do and to help the real estate industry and our business in general?
Yeah, absolutely. Thank you. Thanks for the opportunity, Jeff. Happy to do so. So, I mean, I think it's helpful to just step back a second. A lot of this kind of comes out of the CARES Act, which is the Phase 3 bill, which had about $600 billion in tax relief associated with it. And so there's a lot of implementation issues to ensure that that relief gets out to the businesses that really need it, including real estate businesses. So if you look at that bill, a lot of it is really driving at trying to increase cash flow for businesses during this period of very limited economic activity. And a big part of the way they do that is they go back in time by helping people file amended returns for prior tax years. So, for example, the bill allows taxpayers to carry back losses for 5 years and take those losses and file amended returns. Well, one of the problems was in the haste to pass the CARES Act, there wasn't a lot of opportunity to kind of work through the normal process and think about how these provisions would interact with other aspects of the tax law. And so one of the things that came out of this was the fact that partnerships, of which there are 4 million in the country, half of which are real estate partnerships, as of 2015 are no longer able to file amended tax returns. That was part of the audit reform process that we went through a few years ago. So one of the unintended consequences was that this provision that was designed to help really boost cash flow for businesses wasn't going to be very helpful for real estate partnerships. So our ask was essentially to allow real partnerships of all types, real estate and non-real estate, to basically be able to file a superseding tax return and therefore file a return for 2018, 2019, 2020, and have that take the place of their prior returns. And that would allow them to then kind of claim the retroactive tax benefits that were in the bill. Another element that we've been working on here that came out of the CARES Act was the real property trade or business election for businesses that are electing out of the limitations on the deductibility of business interest. The way the CARES Act worked is they actually increased the amount of deductible interest. And so some people may want to actually live under those limitations so that they can get higher depreciation. Unfortunately, under existing law prior to the CARES Act, there was no ability to go back and revoke your election to be a real property trader business. So that's another one where,
Ryan, that was you had to make that election, and that stuck with you forever. Is that correct? In order to be able to deduct interest or to use the other tax attributes, I guess.
Right. So if you made the election out of the business interest regime, that's a one-time rule, and it was irrevocable. And so when the CARES Act kind of changed the rules for business interest, it didn't change that irrevocability. So we asked Treasury to go back, think about issuing guidance that would basically allow taxpayers to revoke those elections. So in both of these cases, we're very fortunate. Treasury and the IRS came out with new revenue procedures within the last couple weeks that will allow taxpayers, in the case of partnerships, to file amended returns for prior years, and in the case of business interest, to allow people to elect out of their real property trader business election. And this is also going to allow them to get the full benefit of 100% expensing of their real estate improvements, the so-called qualified improvement property, leasehold improvements, basically any improvements to non-residential improvement property. That was meant to be effective back in the end of 2017, but there needed to be a technical correction. That got done here in these provisions that allow for the retroactive filing of amended returns by partnerships will allow businesses to fully benefit there.
Great, good work there. Now let's talk a little bit about what you've been doing at the Treasury Department and the IRS concerning deadlines. We hear a lot about 1031. We hear a lot about opportunity zones, other types of statutory timelines.
Yeah.
I think you've changed those. Let's talk about those for a minute.
Sure. So Treasury has a lot of authority under disaster relief statutes to really provide relief to taxpayers in terms of deadlines, payment obligations, temporarily to push that out. And we saw that happen for individuals. They don't have to file their taxes in April. They can now file them in July. But they also have the ability to do that on particular types of real estate transactions. So for example, like-kind exchanges, if you start down the road of entering into a like-kind exchange, which we know is really common in real estate, you have to identify your replacement property within 45 days, and you have to close on that transaction within 180 days. And those are very strict time limits, and if you don't do that, you don't qualify for the deferral of capital gain on the property that you're relinquishing. So the new Treasury guidance, which we encouraged, provides relief from that. Basically says that if your deadline is sometime between April 1st and July 14th, those deadlines are pushed out until July 15th of this year. So we have this kind of spring and summer period to push out deadlines for like-kind exchanges. The other one where relief's been provided is opportunity zones. Under current law, you've got 180 days to take the gain from a prior investment, the capital gain, and roll that money into an opportunity fund. And the guidance from Treasury, if that allows that to be extended, if that time frame would have elapsed between April 1st and July 14th, the deadline's pushed out until July 15th. So that should be helpful in terms of continuing to keep the opportunity zone investments flowing into opportunity funds. There's more to be done here. We're hoping for actually some additional 1031 relief, and we're hoping for some additional opportunity zone changes. But those are a very helpful initial steps taken by Treasury and IRS in response to requests that we've made along with our partner organizations.
Well, that is terrific, Ryan. Let's talk a little bit. You hear a lot about the problems that are coming for servicers, and most servicers have their mortgages in pools, and they're held in trusts under remits. Typical tax rules require you not to make serious modifications to those loans underlying the pool. That'd be a big problem today. What happened on that?
Yeah. Yeah, I mean, the idea is that mortgage-backed security is basically not supposed to be in the banking business, but it's more or less a conduit for funneling payments from the mortgagors to the bondholders. And so as a general matter, those those things, we call them REMICs for tax purposes, but they're basically mortgage-backed securities. They're restricted under current law from doing any kind of workouts and significant modifications and restructurings of those loans, even when the borrower gets in trouble. So what is really important in a time like this, where you do have a lot of borrowers in trouble, you want to be able to encourage the servicer to make the types of restructurings and workouts that are going to keep those loans and parties together and the financial arrangements working and the funds flowing to the bondholders. And so, but in order for that to happen, we needed IRS and Treasury to issue guidance to basically say that when those workouts are done, they're not going to be treated as a significant modification, and therefore force the REMIC to lose its tax-exempt status. If it did, if the REMIC lost its status under the tax law, then what would happen is there'd be 100% tax on the income generated by the security with regard to that modification. It's called a prohibited transaction, and it basically, you just would not have servicers willing to do those types of workouts with the borrowers. So fortunately, IRS and Treasury issued guidance last week. It's going to allow for COVID-19 related structuring workouts, very broad. It applies to residential and commercial. It applies to private and agency-backed securities, federally backed loans. And it also applies not just when forbearance that's mandated by the government, state or federal, but it also applies to forbearance that's simply voluntary on the part of the servicer. So in that way, we've gotten to a good place I think on this issue, whereas in 2007, 2008, it took like 3 pieces of separate guidance by the IRS to finally get to a really good endpoint on REMICs and protection for servicers for loan workouts. And I think they learned some of the lessons, and we've encouraged them to take those steps, and that's a positive development.
Well, fantastic. So I guess while we're on loan workouts and troubled debt, why don't you talk a minute about the things that we would like to do regarding other significant debt modifications under Section 108 that would normally trigger income under the debt modification?
Yeah, so I'm hearing more and more from our members, particularly in the tax committee, that this is a huge issue. It's going to be a huge issue over the next several months, and there may be no tax issue that could be more helpful to our industry than getting this right, which is basically ensuring that when you have a debt workout between private parties, debt forgiveness, debt cancellation, debt restructuring, that the relief that's given to the borrower that would normally be included in income, it'd be called an inclusion event because it would generate cancellation of indebtedness income, that would normally be taxable. And that's a big obstacle to the parties having the incentive and motivation to work through these issues. So what we want is to give them, during this period of just extraordinary economic stress, kind of a 90-day period or a period through the disaster declaration where any kind of debt restructurings and workouts are not going to trigger COD income, cancellation of indebtedness income. And that alone, I mean, we've already gotten that for the Payment Protection Program, which is the SBA loan program. There, the loan forgiveness aspect of those PPP loans for small and medium-sized businesses, the forgiveness piece there is not income to the borrower. All we're saying is that in the case of private debt forgiveness, there should similarly be no income in the case of the borrower. We shouldn't just be encouraging debt forgiveness for government loans. We should also be encouraging that for loans between private parties. And if we could do that, that would really help parties get to the right place where they need to be on their financial obligations, realigning the parties, And that'll help them keep their employees employed. It'll help keep the businesses running. It'll avoid foreclosures, avoid bankruptcies. And it's an issue not just for businesses, but for individuals too. So COD income is going to be a big item, and we're going to need to get some of that relief. There's some things Treasury can do, but ultimately to exempt that income, Congress is going to have to do that. So that'll be certainly part of our push in phase 4.
Well, great. I know there's several other tax things that you're focused on, some long-term, but others relating particularly to this effort under the mitigation of the COVID impact. Some dealing with REITs, for example, under the middle income business, the ones where there's 500 to 10,000 employees. They have rules that to get those loans, you can't issue a dividend, for example.
Yeah.
And I know you're focused on that because obviously REITs by law have to issue a dividend on their income, and you can't have the government say you can't issue a dividend or you have to issue a dividend. We've got to get that symmetrical working with NAREIT on that. And also, you know, a lot of retailers are clearly in trouble, and some REIT owners of the assets would like to help their tenants during this period of struggling and maybe inject a little equity into those tenants. And there are rules that prohibit that. And I know you've been focused on that a little. Do you want to say anything about that at this point in time?
No. I mean, you hit it you hit it exactly right. It's a very sympathetic issue, which is, you know, you have these mall owners, property owners, REITs that want to help their tenants. They're willing to take an economic interest in them. And there's some very technical REIT rules that preclude them from doing that have to do with related party relationships and the fact that the REIT can't receive good income from a related party. So if it takes an economic interest in its tenant, then the income generated wouldn't be good income. But from a policy standpoint, certainly we should be doing everything we can to save those jobs and save those businesses. So I think that the REIT community, Roundtable and others have a really good rationale for getting that type of relief, because that would be very helpful to the underlying businesses and help keep some of these during these difficult times. But yeah, there's a number of items there, and that's an important one.
Well, I'm sure that anybody watching this is happy to see your skill level and everything, Ryan. I see you're in the office today, and I see those pictures of you with senators and so forth. And it's worth noting that you were a counsel to the Senate Finance Committee before you joined the Roundtable. So we're very happy that you're with us. And also your TPAC, your Tax Policy Advisory Committee that you staff and the Frank Creamer chairs and so forth. That is a real source of knowledge, and both technical knowledge and actual application of these things. And
yeah, I mean, TPAC is our eyes and ears to what's actually happening in the marketplace and in businesses. And so it's been a great resource. We had a good call this morning with, I think, over 100 or so of our members talking through all of these issues. So yeah, couldn't do it without the TPAC participation.
All right. Well, we will let you get back to work and let our viewers get back to their lives. And a lot of this detail is on or a lot of this material is detailed on our website. So you can go to the website, look for the special page on the COVID-19 crisis, and you'll see all of the things that we are working on, and there's certainly a lot more. So Ryan, thank you very much today, and we wish everybody good health, and please call us if you have questions or email us and look at our webpage. Thank you very much. Have a good day.